There we go. All right, away we go today. All right, so I'm Drew Flam, everyone. Nice to meet you. I'm a director here at Munro's, and today I'm very happy to be co-hosting this webinar with Ben Smythe of Minchin Moore. Munro's is located here in Perth, and Ben's all the way over in Sydney. So it's great to have the technology working, as we all know, during this pandemic. Ben, do you want to say hello to everyone?
Good afternoon, everyone, or good morning, wherever you are around the world. Looking forward to spending the next hour with you as we deal with one of the more topical issues that investors are talking about at the moment. So, happy to add our 2 cents to the discussion today. Just to give you a bit of background, Minchin Moore's a independent wealth practice partnership model. I'm one of the partners. Sort of multiple offices in Australia, and deal with sort of the complete range of investors, from accumulators, people building wealth, right through to people in the retirement phase. So, Drew, I'll pass you back to you.
Fantastic. All righty, let's get all this technology working. Got a fair amount of buttons to click. There we go. I'm back on the screen. Brilliant. Okay, so Munro's, who are we? We help Australians build $1 million plus businesses. So you might be here today wondering, why are you doing a webinar on Bitcoin? The fact is that some businesses these days are accepting Bitcoin and cryptocurrency, or people are earning it sort of basically as contractors or through employment. And also it's just generally, it's part of your life's business to accumulate wealth throughout your life. And so investing comes into play. That's why we've got Ben here to give his opinion on the financial side of things, and we help with the tax side of things. So just for everyone, just quickly run through this. Munro's, we do accounting and tax returns. We help people when they're buying businesses. We help people when they're exiting businesses. We're very well known in family farm sector for that, succession planning. And cryptocurrency, of course, we've done some fantastic work in that space, and we're very glad to be helping people out there. Super proud, really super proud of our 5-star rating. 64 Google reviews at the moment. Keeps coming along. There are just a sample there, and I really, sort of put the challenge out there, try and find a firm that's got a better rating than us. Incredibly difficult. So we put on these webinars. They vary. I've previously done some on home loans. Of course, done some on tax planning towards the end of the year, and we really put them on just to provide information pieces so you're more informed. And of course, if your accountant isn't having these conversations with you, then make the switch to Munro's. We'd be pleased to help you out. So today's agenda is we're going to run through when to buy, hold and sell cryptocurrency, how risky is it compared to other assets, tax implications there. Sort of throughout the general conversation, we'll be discussing when do you need a financial advisor, when do you need an accountant, and we've got that Ask Me Anything section, so please use the Q&A button. And of course, very important, you're here today or you're here in the future watching this recording, disclaimer, this is just information to help you out, but it's not personal advice, not tax advice, not financial advice to you. You need to take into account your own circumstances, and highly recommend that you seek professional help from an appropriately qualified person. So let's kick off with just a quick poll gauge with our participants here today. We have quite a number. We've got 63 active participants at the moment. And so just the poll is, I'll launch it now. It's anonymous. Where are you at on your cryptocurrency journey? So we're just launching that poll. Give everyone just a few moments to submit. So you never invested before, you might have just been getting started. I know people are getting back into it. They were into it a few years ago, and now it's piqued their interest again. And quite a number of people in deep. So let's just wrap up that poll, and I believe I can share the results. Share the results to everyone. There you go. We've got quite a mix of people here, so that's fantastic. Let me stop sharing that, and I can now pass the load over to Ben. and Ben will run us through some of the financial aspects of Bitcoin and cryptocurrency. Away you go, Ben.
Brilliant. Thanks, Drew. So as Drew mentioned, we sort of have a bit of an agenda. I guess I always sort of try and attack these sessions, sort of starting about what we're not going to cover. It's probably a shorter conversation. So I guess what this session's not designed to do is to, give our opinion in terms of, whether, Bitcoin's going to $1,000 or, whether we think, this cryptocurrency is better than that cryptocurrency. So it's really designed to share with you, our professional knowledge. So, 20 plus years in finance, myself and Drew with the tax and accounting, to share with you our knowledge in these areas when it comes to cryptocurrency. So things that we've seen over the 20 plus years that we think can help you when you are either thinking about investing or currently holding that investment and looking at options. So that's really what we wanted to talk about today. As Drew mentioned, there's a Q&A at the end, but if anything does come up after the meeting, then drop Drew a message and he can connect you to me as well. So if we sort of dive into the first area in terms of the next slide, I sort of try and attack the question about where do I start. So often, with cryptocurrency, there's a question around, is it right for me? Should I be investing in cryptocurrency? And I personally suggest that you treat cryptocurrency like any other investment decision. So when you are making an investment decision, these are the things that I would suggest that you consider. So firstly, if we start at the top right, you have to have a plan. You have to be guided in terms of what outcome you're looking to achieve. So first and foremost, before diving in, ideally, you should be saying, okay, well, what am I looking to achieve with my investment? Secondly, then flowing on from that, related to investments is, what's my plan around future cash flow needs? And the reason why that's important is because obviously an investment can provide either full cash flow or supplemental cash flow to things like salary and working and that sort of thing. So it's really important, as I said, to understand what your long-term plan or what the outcome you're looking to achieve from the investment. And secondly, what's my plan for funding future cash flow needs? And I'll get to the relevance of that particular question when we sort of dig into investing a bit more about cash flows and that sort of thing. Thirdly, related to, I guess, getting a bit more granular about your plan, you need to understand, I guess, what is your overall wealth plan? What role will cryptocurrency have with respect to buying a property, for example, or, building my superannuation? So it's really, again, looking at what's my plan for building wealth, to generate cash flow. Next, in terms of the discussion tree, is really about the things that Drew's going to talk about. So what's my plan for structuring the holdings? In other words, which entity am I going to hold my investment in? What's my tax plan in terms of structuring? What happens if I pass away? How's that going to affect my investment? So really getting the structure right is obviously also important. And as I say, Drew will talk about some of the implications of that. We then go, okay, well, we've made an investment. How do I keep myself accountable in a sense? I originally decided my outcome for investing in this cryptocurrency was to achieve this. When I get to that point of hitting that outcome, how am I going to make sure I push the button or pull the trigger to make that change? So it's how do I, as I say, keep on track and not get swept up in the emotion. I often, when I talk to clients about investing, as I said at the beginning, whether you're buying crypto or buying a property, it's the same sort of process. The key with investing is always to be unemotional. You have to be ruthless. You have to have a plan. And these are the steps that, we recommend our clients go through. And finally, almost like a sort of a point of inflection, what happens if there's a change in circumstances? Again, what's my plan if I lose my job, for example? or, I want to change tact. Again, just having that sort of plan around that is always really relevant. So to sort of bring that all together, as I touched on at the beginning, if you're thinking about this or potentially, you are already in it, it's never too late to take a step back and think about the investment in terms of these sort of areas. And as I said, cryptocurrency should just be like any other investment you make. You must be ruthless. You must have a plan in terms of what you want to achieve with this investment. If we look at the next slide, so, how do you take that emotion out of the decision making? That's often, often a client will come to us with a reasonable cryptocurrency position. And one of the questions I always like asking is, why have you sought advice? Why now? And it's really interesting for our cryptocurrency clients. They'll say, look, I just needed someone to tell me to take some cash off the table, or to de-risk my portfolio. They weren't confident of having themselves to do it, and that comes back to that point about having a plan and knowing when your outcomes are achieved. But one of the ways that people take the emotion out of the decision making is to engage professionals like ourselves and like Drew. So what I want to do now is just talk about that sort of decision making about when do I buy, when do I hold, and when do I sell? Because again, that's obviously very topical at the moment, as we've seen, particularly Bitcoin obviously have a very monumental run, and that often provides a bit of an inflection point for clients. Either people wanting to get in, or conversely, people with existing holdings going, well, what do I do? Do I cash in now, or do I keep riding? So I guess what we've tried to share with you is some of the feedback that we get from clients, and some of the way we guide clients in terms of these three decisions. So when to buy, I guess the key message is treat crypto as any other investment. So when to buy would be really, if you're in a position, you're saying, you know what, I'm really keen to take on some risk. I'm looking for a return on my investment. I know that current interest rates are at where they are, and I'm not going to get much of a return on my savings. I really keen to take on some risk. The second point, when to buy, is also, I think, fundamental to investing. It's all around this, understanding what I'm investing in. And you've probably heard this before, other blogs and other posts. A lot of people talk about never invest in something you don't understand. And I think that's very, very true for crypto. So in this point, when to buy, I understand crypto and I believe it's a good investment for me. Take some ownership, make sure that you completely understand what you're getting into, is just so fundamental. And again, there are a lot of, obviously, thousands of different cryptocurrency options out there. So my advice is when you're looking to buy, make sure you understand what you're getting into, and make sure you're comfortable with the risk. If we next move to the next decision tree, when to hold. So you currently, got crypto, let's say Bitcoin, you're currently holding Bitcoin, and as we've seen, the price of Bitcoin has increased quite dramatically, and you're wanting to know, when to hold. So the type of decision that should be driven by is again around these 2 points. So you must be, looking for a long-term plan, and you must be happy to ride the ups and downs. I mean, that's, very fundamental investing, but particularly with crypto, because it is so volatile, as we all know. So you have to, if you're going to hold, you have to accept volatility. You have to accept that there could be some ups and there could be some pretty big downs. And so you've got to have that stomach, to withstand that emotional sort of roller coaster, and be able to say, you know what, I'm in this for the long term. It's a long-term plan. I'm happy to accept the volatility. The second reason you might want to hold is the investment is not being used to generate cash flow. You might have a good job, and in your mind, this investment is just cream. I'm happy to hold long term. I'm not relying on this investment to fund my cash flow. I've got a good job. That could be another reason to hold. The final point, and this is obviously relevant at the moment, and this is typically where we will get inquiries from a new client around this, where they hold a pretty significant part of their wealth in crypto, and they want to know when do I sell. So if you go back to we remembered our previous slide, we talked about having a plan and knowing what success looks like in terms of that outcome. So when you sell is when you've achieved what you wanted to achieve with the investment, and it's time to take some cash off the table. So let's use an example. You might say, you might be investing in crypto in order to buy a property, for example, and you've got an eye on a new property, or a first property, an apartment, a house, whatever it is, and that's your outcome. That's what you're looking to achieve. So our advice is always have a very clear plan, and when you hit that plan, that's when you take some cash off the table, because that's being ruthless, that's being unemotional, and that's what investing is all about, looking to achieve what you want to achieve. Drew, can you just scan down the page? I'm just missing the last dot point there. Just bring it up a bit if you can.
I think maybe it's just been cut off.
Okay. Sorry, that's all right. So the other time to sell is really, I guess, when you don't feel comfortable. That's often, a trigger again, whether it's, property, shares, crypto, whatever it is. So typically, another time to, is where you're feeling emotional. You're not comfortable with the risk in your portfolio. You might have all your wealth in crypto and you're looking to de-risk yourself. That will often be, again, another time where a client will come and see us. They'll have all their wealth in crypto and they'll say, look, I just want to, de-risk my portfolio. I feel like I'm going to make some emotional decisions with my investments, and I really, really need some professional help. So that's, sort of the three decision making that we look at. If we look at now, let's say you've made the decision, okay, I'm going to take some cash off the table. The question, often is, well, what am I going to do with it? Why wouldn't I just hold on to my current crypto holding? Is there the saying is, don't sell unless there's something better you can do with it. So you're not going to sell crypto and put the money in a term deposit. That doesn't make sense. But it obviously does come back to your plan, as I spoke about. So, and one of the key things which people invest for is to generate cash flow, because cash flow provides, opportunities. And that's what investing, is often about, putting yourself in a position where you can, generate cash flow in addition to what you're currently doing. So as we spoke about here, there's really two ways to generate cash flow, personal endeavors, your work, your labor, or through investing. And, those two can be quite interchangeable as you start investing and start building up your position. Now, the key thing with crypto is obviously it doesn't provide cash flow. The only way you can generate cash flow is by taking some cash off the table. So if one of the outcomes, if we go back to that plan, let's say one of the outcomes was, I really want to take a step back from work. I want to start generating some passive income. I want to have some, choice around my work. Well, clearly, taking some cash off the table from crypto and starting to build a passive income is a great way to do that. So, in terms of investing, some of the sales proceeds, where we see, great uses is clearly, as I just spoke about, supplementing or replacing salary. Investments that, provide cash flow really open up opportunities around labour and work. And particularly for clients who maybe, post-COVID, might have lost their job, or might be looking at reduced working, or might be coming into retirement, or potentially just might be wanting to early retire. You've got to generate cash flow from investments in order to provide that opportunity. Second option is clearly to repay debt. Clients might have bought property or looking to buy property. Clearly by taking some cash off the table is, obviously is a great way to do that. And finally, as I spoke about before, there is a lot of risk with investing in crypto, as we all know. We accept that because the returns are great, But obviously with risk comes downside. You know, it's not just all cream. You know, the market will move around a lot. And so by taking some cash off the table, or you know, cashing some of the portfolio in, you're able to completely de-risk your portfolio by diversifying across multiple asset classes. So, you know, we have clients who come in with 100% crypto, and within 12 months, you know, we've been able to get them into a property, you know, into a portfolio, and still retain their crypto portfolio. So 12 months later, their whole wealth is really significantly de-risked. And, you know, coming back to that plan, they've been able to achieve what they wanted to achieve by the original investment. Just finally, you know, again, I just can't emphasize this cash flow point enough. You know, if that is an outcome you're wanting to achieve, generating cash flow from your investments, then you are going to need to have a plan around taking some cash off the table, or selling down some of the crypto, because as we know, it doesn't provide a cash flow in that sense. Last bit for me is a pretty common question we get around risk. And I've sort of mentioned it a few times in terms of this, in this session, you know, that you know, is crypto risky? You know, often that question will come up. And to answer that question, you know, it does come back to, you know, that sort of comparison, you know, well, compared to what? You know, what are you thinking about investing in? So if you compare it to other investments, so if, you know, you've got, you know, your standard sort of asset classes of property, you know, shares, funds, ETFs, you know, your cash, fixed interest, cryptocurrency, all of those asset classes have different risk return parameters. And, you know, as everyone would know from an investment perspective, the higher the level of risk, the greater the reward or return that you should be expecting. So in terms of those asset classes, when you think about return can be a function of capital growth as well as income. So when you're making a comparison between asset classes, you need to understand, well, what return am I likely to get from that asset class? So if we think about crypto, as I've mentioned, it doesn't provide an income return. So the sole return that you're getting from a you know, investment perspective is a capital growth or an appreciation in the value of that crypto, what someone's prepared to pay for it. Now, other asset classes, as I've touched on, you know, provide not only capital but income as well. So it is important to bear that in mind when you're thinking about crypto in terms of whether it's risky, because you are only achieving one area of return. But having said that, you know, as we've seen through Bitcoin, the returns can be astronomical, and you are getting compensated for taking on that level of risk currently. So, you know, it is always, you know, important, as I've touched on here, you know, remember the investment return is a function of income and capital growth. And when you're comparing, you have to bear that in mind. You should be getting rewarded from crypto because you're taking on a lot more risk, because you're only getting one area of return. So it is risky. But again, you know, coming back to what I have spoken about quite a bit about, if you have that plan and you understand risk and you understand the investment and you're prepared to ride the ups and downs, then you know, it is a risk that can be managed. If we sort of go back to where we started in terms of you know, looking at cryptocurrency, again, I would strongly encourage you to treat it like any other investment decision. So when assessing investments, you know, as I touched on the beginning, whether it's crypto, you know, or property or shares, you know, we always come back to these principles when we're guiding our clients through these investments. So first and foremost, you know, you've just got to understand what you're investing in. You know, you often hear about, you know, people losing money through various crypto options. And really, I think that comes down to people not actually understanding what they're investing in and understanding what the risks are, because there are, as we all know, slightly different options in terms of the way cryptos work. So take the time, do your research, and make sure you understand what you're getting into, understand how you get out of it, understand how it's valued, all those sort of key principles. As I touched on before, understand the risk. What's the risk I'm taking on? What's the likely return? How does that compare to other investment classes? Am I going to get rewarded for taking on that additional level of risk with cryptocurrency? Diversification, it's such a tried and proven mechanism when it comes to investments. That there's just such good evidence and such good research to support the importance of diversification. And as I touched on, the ability to diversify is only really achieved when you take some cash off the table and de-risk your portfolio. And the final point is really having an understanding about that structure piece. What are the tax implications of this investment? When do I pay my tax? Do I need to put that aside? What's the best structure? Do I need to look at a company or a trust or the entity and that sort of thing? And that's obviously where Drew and his team come in. And at that juncture, I will pass you over to Drew.
Thanks very much there, Ben. Some fantastic information there. I think before I get on to some of the tax side of things, we did have a question come through, and it was in relation to these days with some of the innovations going on in the crypto space. There is sort of the possibility of earning passive income, if you can call it that, through owning cryptocurrency. And I think the main point to be made is, even if you were able to some extent earn a passive income through crypto, really the key point is that's still within the same asset class, and it also comes with its similar risks. Whereas opposed to if you go on and you have a share portfolio or a property portfolio or some mix of it, that's a different passive income. Would you say that's a fair comment there, Ben? Yeah, definitely. Look, you'd want to understand the robustness, I guess, of the passive income stream in terms of the crypto, and I think the question talks about getting a return on lending out sort of a parcel of Bitcoin or wrapping around something and lending it out and getting a return on that. Look, there are going to be innovations that come to market and look at how you can generate passive income, because I think that is probably one of the limitations with that asset class or that investment. You are heavily tied to the appreciation of the value of that particular crypto. But yeah, the point around de-risking a portfolio is obviously relevant as well, in that if your plan is to buy a property or reduce your work or those sort of things, then having some spreading your risk is really what's going to achieve that. Yeah, fantastic. So I suppose and once again, just before I get onto my thing, the question to you, Ben, is, as a financial advisor, like when should someone come and start speaking to you or your colleagues in your industry? What does that look like? What's involved? And the classic question, what does that cost? Yeah. So I think probably the key time to engage with a financial advisor is really when you're ready and willing to take on advice. I mean, that's the key, because ultimately it's like any sort of engagement with a professional. You have to be prepared to take advice. I mean, that's what you're engaging and that's what you're paying for. If you're looking for someone to rubber stamp or confirm what you're doing, it's not beneficial relationship with engaging with someone like us. I mean, typically clients with crypto engage us when they've accumulated a pretty significant amount in their portfolio and they're looking for advice in terms of what next. Do I continue to hold it? Do I take some cash off the table? What should I be doing? And for us, as a financial advisor, ultimately all we're doing is really putting ourselves in your shoes and saying, okay, well, if I was in your shoes and these are the outcomes that I was looking to achieve, and this is what I had in terms of my wealth bucket, then this is what I'd be suggesting.
we do. And a lot of times, when you think about crypto, you think about the sort of the sort of pros and cons, I guess, in terms of taking some cash off the table. Ultimately, as we've seen, particularly through Bitcoin, a number of our clients have been able to, achieve those outcomes that are important to them while still maintaining a meaningful balance, which is only increased. So they've been able to still capture the upside, but completely de-risk their portfolio. Now, in that same situation, if they hadn't taken cash to the table and Bitcoin, as an example, had a significant reverse, in other words, it dropped in value, then not only have they not achieved, what they wanted to achieve, but they're still in the same risk position. So there's some real value with when you get to that position of having some meaningful exposure to, really ride that upside and de-risk your portfolio. So that's sort of when they come to us. In terms of fees, so we don't receive any commissions or third-party payments or anything like that. The only fee that we receive is from our clients. So we, quote them a fee relative to an agreed scope of service, like any professional, like an accountant, like Drew, and we clients pay our fee relative to that scope of service. So it's really transparent. We don't have a sort of a set fee schedule because every client's, circumstances and needs are different. We just engage with clients on a 12-monthly basis. Every 12 months, we give them a scope of service. We quote them a fee relative to that scope of service and ideally re-engage every 12 months.
Yeah, fantastic, Ben. So I suppose, on the topic of what's a substantial holding or whatever, I'd say, and we've seen this massive run up lately. I've seen some people that put in $500,000, and they're lucky enough at the moment to be theoretically sitting on about $1 million. That's a great time to talk to you. Yeah.
Look, I definitely say. I mean, again, interesting. If you've got a plan, as I said at the beginning, it's been interesting just gauging why clients have engaged us with crypto, and the feedback we've got is that they want someone to tell them to take some cash off the table. They've got to a stage where their exposure or their value is so significant in their own personal terms, and it's so it's related to what they wanted to achieve that now they can what I really wanted to buy that property and I can buy that property, or I really wanted to reduce my work and I actually can take my work. But, they need some guidance, they need some advice in terms of how much and what are we going to do with it and all those sort of things.
Yeah. So that emotional side of things, and just generally, you don't know what you don't know. And that's one of the major benefits of engaging a professional, is they can actually run through things that you wouldn't otherwise have thought of. And then you might actually have a different opinion of things. You might be more certain or feel more relieved to have peace of mind knowing you're doing the right thing, or you might be like, oh, I didn't think about it that way, and maybe I should take some action now.
Yeah, and look, we're agnostic. We're not a firm that says you must have everything in property or you must have everything in shares. As I said, we've got clients with money in crypto and other, a whole variety of asset classes. Ultimately, all we're trying to do is, create a plan, create a long-term wealth accumulation, plan for a client that, maximizes the return that they want to achieve across the whole range of asset classes. So, don't be afraid that we're going to say, you've got to get rid of crypto, don't touch crypto or anything like that. We're very open to, the broad range of asset classes.
Yeah, brilliant. All right. Well, if you're just hanging there, Ben, I'll run through some of the tax stuff now, and then we'll engage again during the Q&A section. So if anyone does have any questions for Ben, feel free to use that Q&A button there. Otherwise, so we're up to the basics. What are the basics when it comes to cryptocurrency? And really, I always like to make the point that taxing events, definitely the most substantial ones coming off the appreciation of value of something, of an asset, are disposal events. And these aren't simply disposing of your Bitcoin or your cryptocurrency back to Australian dollars. It's not limited to that. It can include going from one cryptocurrency to another cryptocurrency. These are disposal events. It can include gifting your cryptocurrency to someone else or transferring it from one of your entities to another. And another one is using it for purchases. Some of the more classic examples are going out and buying a digital wallet, a Trezor or a Ledger are generally the most popular ones we come across, and people use some of their cryptocurrency to purchase these things. They would have their own taxable events, gains and losses to be reported there. So coming off that, you go, what is that? How do you calculate that gain? You basically go, okay, when you're disposing of that cryptocurrency, nice and easy if it's back to Australian dollars. Obviously, it's whatever the Australian dollars you get. But if it's to another cryptocurrency, it's whatever the value was at that time. So let's just run through an example. You might go out, you buy some Bitcoin for $1,000. Then, I don't know, 2 months later, you decide, hey, I'm no longer wanting this Bitcoin, I want to buy some Ethereum. At this stage, your Bitcoin is now worth $5,000. You convert it over, you've got $5,000 worth of Ethereum. That is the cost for that Ethereum. And you've also made a $4,000 gain in that scenario. For capital gains purposes, so assuming you're an investor, we look at how long did you hold that for? So in that example I just gave you, you own that asset, that Bitcoin, for only 2 months. So it's going to be fully reportable. This is different if you had owned that asset for more than 12 months. Let's call it 14 months, maybe 2 years. It doesn't really matter. As long as that same asset has been held for more than 12 months, you could possibly get what's known as the CGT discount. This is a 50% discount on your gain. So in the most simple scenario there, where I've only made a $4,000 gain on Bitcoin, owned it for more than 12 months, I get 50% of that, $2,000 tax-free. Happy days. The other $2,000 I put in my tax return and I pay tax on it at whatever my marginal tax rate is. So if my marginal tax rate's 39%, I pay 39% on it. Or one way to look at it is for the $4,000 gain, I pay tax at almost 20%. So basically half your tax rate. But always clear, need to point out that when it comes to these capital gains tax discounts, they're after applying losses. So if you also had another loss that year, in that financial year, or you're carrying forward a capital loss from a previous year, let's call it $2,000 loss. You would have gone $4,000 gain minus the $2,000 loss. Now I apply the discount. You don't apply the discount and then the loss afterwards. And I put there as point number 3. I'll revisit personal use exemption in a moment. But very important since we're on this topic about capital losses. With the volatility of the crypto market, we've definitely seen this happen in the 2018 financial year when prices were running up very high in late 2017 calendar year, and then they started to tip. But the majority of the fall happened post the 2018 financial year. So what a lot of people did is they accumulated a lot of taxable gains as the price was running up. And then when prices started to fall, they weren't actively trading as much. So they weren't crystallizing, or otherwise known as realizing their gains. They were just sitting on losses. Those losses were just paper losses, unrealized we call them. And they didn't start actually selling down those assets until it was after 30 June. The trouble there was that they made all these taxable gains in 1 year and they made losses in a later year. The difficulty in that scenario is, particularly if you've just reinvested your profits into the losing asset, is that you've got to pay tax now on the gain that you've actually realized, but you can't use that loss to offset your gain because the loss happened in a later tax year. You can only carry forward that loss until you subsequently make further capital gains. So it's really important to recognise that, and particularly right now, we're doing a number of consultations for people and that they are experiencing some of these gains very similar to that previous run-up. And the big recommendation has been, look, sometime in May or early June, reach out to us, let us know, let's do a tax estimate, because you might not be aware that you've accumulated all these tax debts. So at the very least, you want to realise and know what your tax debt is so you can plan for it. You might then decide, okay, I want to take some off the table, put it in dollars, prepared to pay my tax return. There might be even cases where there can be things to do. to minimise your tax. So very aware of that, particularly during this current phase of the volatility we're going through. When it comes to the personal use exemption, it's something that's really misunderstood, and I think it's fair enough to have it misunderstood. It is difficult to understand. It's an exemption within the capital gains tax rules that exists, and it's not just specifically about cryptocurrency. But what it does say is, and this is where it gets really misunderstood, it says something to the effect of a $10,000 cost. So a lot of people interpret this as meaning I can make up to $10,000 in gains without paying any tax. Certainly not the case, unfortunately. Wish it was, but it's not. Personal use exemption is really only there if you go out specifically to acquire an asset that you're going to dispose of for personal reasons. I'll give you a nice, clear example. Maybe I want to go and use a VPN service out of wherever, somewhere around the world. They only accept Bitcoin for that VPN service. So last week, I went on the exchange, I bought some Bitcoin specifically in order to pay for that VPN service. Whatever reason, really busy this last week, and I'm only just getting around to buying that VPN service now. I've only bought that Bitcoin for a personal use for the VPN service. So if my Bitcoin happened to double in value, it doesn't matter what that gain was made. If it made a loss, it doesn't matter. That's exempt from tax. Don't have to worry about it. But see there, it was only if it was for a personal use reason. So wherever you're speculating on the price, which is, we all know that's the vast majority of cases, certainly that's going to be the default position taken by the ATO, is you're going to have to pay tax on it to some extent. So around the basics, always like to point out that Medicare levy surcharge. That applies if you reach a certain threshold, either as an individual or if you have a partner, as a partner level in terms of your taxable income. If you don't have private health hospital insurance, so an appropriate level of health insurance, you can speak to your health insurance provider as to whether or not you have it. You can be subject to the Medicare levy surcharge. So what happens is cryptocurrency, very volatile. Some years you might be lucky enough, you might make some tremendous profits, and it will really throw your taxable income up as compared to previous years. If you don't have that private health insurance, you can be up for another 1.5% of tax, additional tax you otherwise could have avoided by simply having private health insurance. So always a critical thing to look at and consider whether or not you want to take that out to avoid the surcharge. There is the record keeping, the great old record keeping. Cryptocurrency, always going all over the place. People get in, especially during these hype cycles, like to do a lot. There's different cryptocurrency as to the mix of the complexity. There's so many decimal points, and some of them go out to 16 decimal points. And some way you've got to keep a record of this. It's your obligation as a taxpayer to keep a record of your transactions. And it's vitally important that you do for the bare minimum in order to substantiate if you qualify for the capital gains discount. Because you want to be able to prove that you've held that asset for more than 12 months. So record keeping, cryptocurrency is still a relatively young industry. There's no perfect solutions. And because of the fact that crypto can be sent from one account to another, it does make it really difficult. So there's some options out there. There's always look at the exchanges, and they should be able to export out the information, whether through a spreadsheet file or a CSV file. That would be the bare minimum that you'd need. And you want to keep you want to be able to extract that out on a semi-regular basis, because we know that sometimes exchanges go down. There's difficulty if you're doing transactions purely on the blockchain. We'll visit DeFi in just a moment because it's not so easy to grab those records, but to some extent you're going to have to get them. There are some softwares out there. We refer to these softwares as being relatively all right at doing cryptocurrency bookkeeping, especially softwares. If you connect wallets up, exchanges up, they should be able to import things and keep it okay. Some of all your transactions, a compilation of those transactions, but there's often times you've got to jump in and do a lot of work with that information. So when it comes to your tax reporting, your options really are, you can use your do-it-yourself system. If you're up for it, fair game, good on you. but it is going to be rather difficult. Some of these softwares do enable you to do tax reports out of them. In our experience, we've never found them to be terribly reliable. The circumstances are that there's different methods that you can use to calculate your gains, and unless your records are absolutely perfect within those set of books, the reports can be far out, not accurately calculating gains, accurately calculating the losses. And in sometimes, in fact, most of the time, they're prepared from a tax point of view from a US jurisdiction or somewhere else, not exactly what the Australian tax jurisdiction is. So that's an option, but there's always the fallback to the professional help, whether that be us or someone else. We're very experienced dealing with cryptocurrency. We have our own systems in place. We're very proud of those systems and procedures that we follow, and we'll get everything prepared and accurate for you and really give you the peace of mind and certainty knowing that everything's done correctly. Different costs involved, do it yourself. Obviously, that's going to be a lower cost, but the quality and the reassurance you get out of that is going to be different. So it's entirely up to you what method you prefer to take. So there's ownership, just checking the time that we have. Yeah, we're doing okay with time. That's good. Okay, so ownership structuring of crypto. A lot of people, they first jump in without really considering this. So they either have bought the cryptocurrency and owned it in their own personal capacity or as joint ownership with their partner. If it's solely yours, if you're the sole owner of the cryptocurrency, whatever gains and losses you make are going into your tax return. As opposed to if it's a joint ownership, it's a 50-50, 50% yours, 50% in your partner's tax return. We like to recommend family trusts on a number of occasions. Accountants love them anyway. They give us a lot of flexibility in terms of tax planning because trusts themselves, they don't pay tax. They distribute their profits out to beneficiaries and the beneficiaries pay tax. So don't get me wrong, you're not avoiding tax. You're just enabling some flexibility to work out and take advantage of lower tax rates around the place. And as part of this strategy, you might employ what's called a bucket company. That can be definitely beneficial when you have wild volatility on the upside. In short periods of time, you might make a substantial amount of non-discountable gains. So those gains made in a short period, less than 12 months. If you put them all in your own tax return, man, you might be up to the 47% tax rate. As opposed to if we chuck them in a bucket company, at least delaying paying that tax at 47% tax rate, because we're only paying it at probably the 30% tax rate in the company for that moment. And then at some stage, we're going to flow those profits out because you're going to use them for something. And that's through a dividend strategy. And this can be where you save some tax. A company would pretty much only be used if you're a really active trader, you're carrying on a trading business. The reason being is because if you held an investment, a longer term investment in a company, you can never access the capital gains tax discount from that because companies don't qualify for it. So it is quite rare. If you're carrying on a business, a company could certainly be the case, definitely in terms of like a mining business and the like, and we have helped some people out with those. But companies, sort of typically as people are jumping in, not the first place we look at. And we've noticed on those slides, self-managed super funds. As far as I'm aware, there's no way to access exposure to cryptocurrency within a traditional superannuation account. So you would have to start up a self-managed super fund. Critical point there, highly regulated industry. And the onus is on you to manage it, hence the term self-managed. So it's really not for everyone. Rule of thumb, bare minimum, you should start off with would be 200 grand. I know some people started with less. You have to go through a whole process to start up. And if you needed help with that, we can help with that process. Ben could probably help, no doubt as well. From a tax point of view, fantastic. Superannuation, lowest tax environment there is. Manager drawback. If you're making the profits in super, you're nowhere near retirement, you're basically not going to be able to take them to use for personal reasons at this stage in your life. So I did mention around DeFi that I mentioned it. DeFi stands for decentralized finance. It's the new hit hype thing at the moment. And there's also centralized finance closely related to all of this. And these are applications where you can do direct peer-to-peer transactions. You can wrap your cryptocurrency. You can go into yield farming, liquidity pools, loan your crypto out, loan apparently, but not always. And really, the point is, this place it's an accounting and tax nightmare waiting to happen. Seriously, there's a lot of stuff going on. There's all these different protocols, all these different transactions you can have. Some of the stuff is done every Ethereum block, so it's like every 15 seconds. Think about how hard that's going to be to document. And sometimes on the face of it, what might appear to be the general tax outcome isn't the case unless you dive in deep. And I know that because our team was sitting around this boardroom table yesterday, looking at it, looking at the scenario where you go and you apparently lend out your cryptocurrency. You take borrowings on your cryptocurrency and you put up your cryptocurrency as collateral, so you maintain ownership to it. That was what it seemed on the face value. But when you dived in deep into those terms and conditions, that was not the case. What you were actually doing, you were actually having a direct sale of your cryptocurrency. Major difference there is, if you had just retained it and it was actually genuinely collateral, that wouldn't be a taxable event, as opposed to what actually is the scenario. Even though they call it collateral, it was a sale, you've now got to pay tax on that because it's been a disposal. So that could have huge implications. So tread very carefully in this space. And if you are in that space, be prepared for a seriously large accounting bill. I'm talking $10,000 plus if you're in there and you're doing a lot of stuff, because it's complicated. Every protocol has different applications. You have to dive in and look at it. That's a lot of manual work to be done. So I've gone through a lot of the basics there, which is really good to get through. Look at my time, brilliant. We've got some time for questions, so please use that Q&A box to submit any questions. A reminder to everyone that we have been recording today, so presumably the recording is working perfectly, and so please check your inbox at some stage when we'll send out the link to the recording. And before we dive into the questions, just really interested to know, I'll launch another poll here today just to find out how's everyone rating the webinar. Have we done pretty well? Have we done fantastically? I really hope fantastically. It just gives us an idea of how we're going. Yeah, thanks very much for submitting that. My apologies for not hitting the target for someone who says it needs a bit of improvement. I'd love to hear your feedback on that. I'll end the poll there, share the results. There you go. You see, a lot of people think it's fantastic and pretty good, so that's always fantastic to see. Okay, so questions. Ready for the questions, Ben?
Absolutely.
Brilliant. Okay, so let me bring up. So can Bitcoin be spent on anything other than a Tesla, or is it traded like shares? Well, theoretically, it can be used to buy things. How many things you can buy, at this stage, not really too much. And it sort of is traded like shares. And if you spend it on something, how will the value be calculated? As I mentioned, it's really about, okay, if you have spent it, what was the value at that time? That's the reference point as the seller proceeds to work out what gain and loss you've made. Okay, so is it worthwhile to set up a company to trade crypto? Possibly. You don't know. Even if you have no plans to hold for 12 months, it might still not be necessary at this stage to set up a company. You might revert back to a family trust or just in your own name. It depends on your circumstances. So it would be something that we would explore. Where is the intrinsic value in crypto? Thoughts, Ben?
Good question. It's a question which is debated quite a lot at the moment. So really at the moment, there is a limited amount of value in terms of trading, as we touched on that first question. So, there's some discussion in the first question about Tesla. Obviously, Elon Musk buying cryptocurrency and suggesting that, you'll be able to use crypto to purchase Tesla cars going forward. So the value really is in what someone else values that at the moment. In other words, what's the price that's really the only value in most cryptocurrencies. So it is very speculative, at the moment, because it's not a tradable asset at the moment like other currencies. Although that's obviously the hope. The advantage of crypto in terms of having a value is it's limited supply, as we know. So that does create some inherent value in it. It's limited to, was it 21 million coins? So there's an argument about that. But at the moment, it's really just what someone is prepared to pay for it. And at the moment, the demand, for example, Bitcoin is driving up that value because there's a lot of people wanting to purchase it. And that's where we land at the moment.
Yeah, it's always a very good question. Intrinsic value. Does anything have intrinsic value? Would be my question back to the person who submitted that. Is a gift of cryptocurrency from one person to another a disposal? Yep, that's a disposal. And even if you're gifting it, it's a gift, so you're not getting anything back from the tax point of view. Within the law, we will activate most likely the market value substitution rule, which essentially we go, okay, what was the value of that crypto at that time? And you will be deemed to have received that. So you will actually have a gain and loss to be calculated there. What is the effective tax rate when earning capital gains at zero cost base? So this is someone who's receiving some tokens as part of, I'm not exactly sure what the scenario is, but they're asking, do they have to report it from an income when they receive it, or is it only basically when it's sold? Look, it depends on the circumstances. There's both ways. There's a possibility that's income at that time, or a possibility maybe it's only when you sell it. And you'd have to look at the finer details for that one. I'm just wondering if I'm able to cash out your crypto in June and basically not do all the record keeping, make it nice and easy. Could you do it? Maybe. Can you do it technically from tax point of view? No, it's your obligation as a taxpayer to keep a record of all your transactions and appropriately work out everything. And then you asked about wash trading. Wash trading, if anyone's not aware, is, to put it very simply, you just go about disposing of an asset in order to create a taxing event just to rebuy it back at some stage very soon. The taxman doesn't like that. This one here. What do you reckon about this one, Ben? Is there any liquidity risk associated with Bitcoin? What's the expected growth rate over the next 5 years?
Yeah, good. So I'll just polish my crystal ball there. But the first one, look, one of probably the strengths of Bitcoin when compared to other cryptos is the liquidity. It's reputable, and we have clients who have cashed out. So the liquidity risk associated with Bitcoin, provided you've retained your wallet and use a reputable trader in order to cash in, then liquidity risk is relatively low. But obviously there's a lot of liquidity risk with other cryptos, and the growth rate over the next 5 years, well, it's going to be bumpy. That's all I can tell you.
I like that answer.
No idea.
Yeah, neither do I. What are the tax implications of taking out a loan backed by Bitcoin? What's to stop you taking out a loan and basically the taxable event? As I was sort of getting at during that DeFi, CeFi conversation, it's very critical that you look at the exact terms of that possible loan and what's going on there, because there may or may not be a taxable event. There's no easy answer here because, as I said, platforms, protocols are all a little bit different, and you can definitely be caught out, even though you might be thinking, there hasn't been a disposable event. So be very careful. This one's about collectibles, digital collectibles and gamified objects and using tokens, and there possibly been a huge investment opportunity apparently in the coming years. Are you aware of these? Do they have different tax strategies involved? Sort of generally, the tax outcome is the same. You look at them as an asset. Have you been speculating on the price? If so, then it's an investment that's has to look at your capital gains or losses. If you've simply been using them as part of your gaming and it's just personal use, you're not speculating on the price, maybe the personal use exemption comes into play. Just very mindful that if you hold any asset for any length of time, a decent length of time there, the ATO is going to default to saying, yeah, you're speculating on the price. So you'd have to have a lot of evidence to prove otherwise. And I think this will have to be the last question we take. So we just hit the hour mark. If an individual has already purchased cryptocurrency under their personal name, is it too late to set up tax-effective structures? Look, it's not too late, and it just may have some considerable implications, depending on not if you want to just purchase all your future cryptocurrency in different structure, or if you want to move everything over now. You're sitting on a lot of paper gains at the moment and then transferring it off. Over, say it's gone from your personal name to a trust, that's going to be a taxing event. And if you're sitting on paper profits, you realise those, you're going to have to pay tax on them in your personal name. So it'd be a delicate one. You have to manage that very carefully. Been helping a number of people out lately with that scenario. So unfortunately, these were some of the other questions were submitted, but we don't have time to get through. So once again, please remember to keep an eye out for an email coming your way with a link to this this video. Please feel welcome to share it as far and wide as you wish. Reminder, your accountant isn't having these conversations with you, and we'd be pleased to have you on board here at Munro's. So thank you very much, Ben, for joining me today. Some fantastic information there that you provided. Everyone, thank you for joining. Please stay safe and all the best with your investments. Thank you.
Thanks, Drew.